Hi guys, you welcome to test driller class for bookkeeping and accounting. The first topic of discussion is nature and significance of accounting. So we are going to start with the meaning of bookkeeping and accounting. What is bookkeeping? Bookkeeping is the act of keeping daily record of business transactions in an organized manner. So, bookkeeping from time immemorial has been defined as a science of recording business transactions in a systematic manner so as to exact financial position of a business organization. A business organization needs to keep records of its business transactions. So the act of making sure that the records of a business organization are kept in a particular order is said to be bookkeeping, and it is done by a person known as a bookkeeper. A bookkeeper could be a teller, it could be a cashier, a bookkeeper could be a storekeeper or a shop attendant. But the primary purpose is to keep daily record of business transaction. So the next is the meaning of accounting. Accounting is said to be the process of using the record kept by the bookkeeper to make meaningful information for the users of accounts, or we call them the stakeholders. So accounting is the process of obtaining, recording, classifying, summarizing, reporting, interpreting, and presenting financial information in a manner that will facilitate informed decision by the users of accounting information. An accounting scholar known as Boateng in 1884 defined accounting as the process of identifying, measuring, and communicating economic and financial information to permit informed judgment and decision by the users of accounting information. So, accounting is done by accountants. So, an accountant keeps use the record kept by the bookkeeper to make meaningful information that will be useful to stakeholders so as to make informed decisions or decision that will help the organization achieve its goals. Who are the stakeholders? Who are the users of accounting information? They consist of the owners of business, which is the shareholders. They consist of employees. They consist of the public, government, financial analysts, we have the creditors, we have banks, and we have trade union and financial analysts. They make use of accounts to make meaningful information. Now let's look at the origin of accounting. Now let's talk about the history of accounting in Nigeria. The history of accounting in Nigeria can also be dated to a man known as Luca Pacioli. The man is an Italian mathematician who is the person that invented accounting all over the world. But in Nigeria, there have been history about international trade back in the days. We are talking about the days before independence in Nigeria. So our, our forefathers have been keeping records of business transactions, even in the ancient Oyo Empire, Benin Empire, and even the northern part of the country. They've been keeping records of their business activities. That's how accounting started. And the granting of the Royal Charter to Niger Company in 1886 also necessitated the preparation of accounting records that led to the transfer of the company. And from that time till the independence of Nigeria in October 1960, there were records of business transactions by companies. And if you take a look at it, all right, the Association of Accountants of Nigeria, which is now the Institute of Chartered Accountants of Nigeria, was established in 1965. Why was it established? Is because there were history of accounts being prepared in Nigeria. Now, in 1965, the federal government of Nigeria passed a law that created the Institute of Chartered Accountants of Nigeria, with affiliates to accounting profession in Britain and United States of America. We all know that Nigeria was colonized by the Britain. So we have so many accountants that were tutored by British universities, which most of them were chartered in the UK. And the prominent person, which happened to be the chief of all of them, is the chief Akintola Williams, was one of those that happened to be the member of the Institute of Chartered Accountants of Nigeria. Then in 1982, the Nigerian Accounting Standard Board was born, and we brought about the Statement of Accounting Standard, in which Central Bank of Nigeria, Ministry of Finance, Nigeria Accounting Teachers Association, Chambers of Commerce, and Office of Auditor General of Nigeria was member. But now, as it stands, the standard organization, the statement of accounting standard is ceased to exist. It's now the International Financial Reporting Standard, which was propounded by the International Financial Reporting Board. So as it stands now, is the International Financial Reporting Standard that we use to regulate accounting in Nigeria and all over the world. So this is the brief history of accounting in Nigeria. Now let's look at the of qualities and accounting ethics that any bookkeeper or accountant must have. Number one is honesty. And simply, honesty means that one must be truthful in what one does. So someone that wants to be a bookkeeper or an accountant must learn to be truthful in everything he or she does. Number two is transparency. An accountant must learn to be transparent, which means such person must be open-minded. The person must be straightforward in all his dealings with the client and other colleagues at the place of work. Number three is integrity. An accountant should behave with integrity in all professional, business, and financial relationship, which means there must be no relationship that is unfair in his or her activities in preparing accounts. Number four, an accountant must be accountable, which means there must be accountability in the activities that is being performed by an accountant, which means accountant should acknowledge and accept personal accountability for the ethical qualities of their decisions and missions to themselves, clients, and their company. So an accountant must be what? Accountable for every transaction recorded in the books of accounts. Number five is fairness. So there must not be room for biasness in the recording of business transactions. So in all the dealings of an accountant, there must be fairness in everything he or she does. Number six is objectivity. The process of preparing accounts must be to favor the organization. It must not be with bias judgment. Then finally, there must be trustworthy in the dealing of an accountant or a bookkeeper, which means that the state of relying and depending on someone's ability, profession, and competency must be clean and clear. So these are the qualities of an accounting ethics. Now let's look at accounting concepts. Accounting concepts refers to the broad basic assumptions that guides the preparation of financial statements so as to ensure uniformity in the preparation of accounts all over the world. In Nigeria, our formal language is English. If we prepare accounts, it must be the same way that those in other countries that doesn't use English as the official language will prepare accounts. So why is that so? Is because of the accounting principles known as accounting concepts. So we refer accounting concepts to be accounting principles and fundamental accounting postulates. They are rules adopted as guides to actions in preparation of financial statements. And we are going to look at the accounting concepts one after the other. Number one accounting concept is entity concept. Entity concept states that a business organization is distinct from its owners. So the records of the business organization must be kept separate from that of the owners of the business organization. So it is because of entity concepts that we have drawings in the books of accounts, because the expenses of the business must be kept separate from that of the owners of business. So it's the entity concept draws a distinction between the business and the owner. All right. So let's look at the other one, which is going concern concept. Going concern concept states that a business organization prepares accounts with assumptions that it will continue to exist for the foreseeable future, which means it exists till perpetuity, forever. That is why at the end of accounts, we have balance carried down and we have balance brought down. The reason why we have balance carried down is that we don't plan to end the account because the business continues to foreseeable future. So the balance carried down uh, will be brought down in the next accounting period. So going concern concept is an assumption that an organization will exist forever, at least in the foreseeable future, except otherwise proven. This concept is the authority behind the recording of assets in the books, where values of properties are extended into the future, especially as concerning their monetary benefits. Number next concept is money concept. Money concept states that all financial transactions must be expressed with the currency in use in that location. The currency used in recording the financial data can be translated into other currency using convertible nature of money. This concept believes strongly that only financial oriented transactions should be given effect. Money concept simply means that all accounting records must be in monetary value and it must be in currency in use in the country that it is being prepared. That is why when we prepare accounts, you see, in Nigeria here we use naira. If it is prepared in Ghana, they will use cedi. If it is prepared in America, they will use dollars. Why? Because of money concept in accounting. The next concept is historical cost concept. Historical cost concept states that the cost value of financial transaction should be used in recording such a transaction instead of fair current market value, which means that the cost in which an asset is purchased should be recorded in the books of accounts, not the current market value of that asset. That is what historical cost concept states. Now let's look at this example where Olu purchased a Honda car latest series for 2 million naira in Lagos, while his friends Musa bought the same brand of Honda car at some value for 1.5 million in Togo. It is expected that Olu should record his vehicle based on 2 million and not otherwise, while Musa do as 1.5 and not otherwise. We have two people in this example. We have Olu and Musa. Olu bought his own car for 2 million naira. Musa bought his own car somewhere else for 1.5 million. So in the records of Olu, Olu will record his own car for 2 million naira, not the current market value at which Musa bought his own. So if Musa is to record his own, Musa will record his own at the cost of acquisition, not the current market value. The next accounting concept is matching concept. Matching concept otherwise known as Accra concept, states that the income of a particular period should agree with the expenditure of the same period. Consequently, the relevant costs incurred in fetching a particular income should match together in arriving at the actual profit or loss of the concern. Simply, matching concept means that at a particular period, one must compare the income and expenses to determine whether there's profit or loss, which means all incomes must be compared with what expenses and determine whether there's profit and loss for the business. The next accounting concept is periodicity concept. And periodicity concept is also known as time interval concept, which states that financial records and statements should be prepared for a period of 12 calendar months as agreed to by the users of financial statements and the accounting world in general. The periodicity concept is the follow up of the going concern concept, which states that a concern or entity will exist for forever except otherwise proven. The life of a concern or entity therefore emanates from commencement to cessation. Consequently, a company cannot wait until cessation to prepare its records and statements. The users of financial statements deem it fit to prepare statements after 12 calendar months. Periodicity concept states that for the period of 365 days, 52 weeks, which is the same as what 12 months, a business organization must be able to determine the results of operation of the business, whether the business has made profit or whether the business has made loss. And that result of operation can be compared with competitors to determine whether the business is doing fine or otherwise. So that is the reason why when you prepare accounts, you say for the year ended, especially final accounts like trading profit or loss accounts, partnership accounts, manufacturing accounts, departmental accounts, all these accounts we say for the year ended because they are final accounts, the accounts used to determine the results of operation of a business organization. They are usually prepared at the end of the accounting period of that organization. This occur because of periodicity concept. The next accounting concept is double entry concept. Double entry concept states that in any transaction, that is to say, a financial event, there must be a debit and a corresponding credit entry. The total debit side must be equal or agree with the credit side, which is the reason behind the agreement of the balance sheet. The double entry concept states that any business transactions must affect two entry, which is to either debit the first and credit the second account or to credit the first account and debit the next account. So double entry concept is the reason why we have the golden rule in accounting, which is the double entry principle. So the double entry principle is as a result of double entry concept, which states that a business transaction will affect two accounts. You either debit the first account and credit the second account, or you credit the first account and debit the second account. The last accounting concept is realization concept. Realization concept states that the income and expenditure of a concern or entity must be objectively determined. That is, income earned by an organization should be based on the services rendered, received, and receivable in line with the reality of the transaction. For instance, the income received from a contract awarded should be used on the cost of work incurred. Realization concept means that income should be recognized when the goods and services has been delivered to the final consumers. Or if we are talking about a seller and a buyer, once the seller deliver the goods to the buyer, the income can be said to be what? Recognized from such purpose. Now let's look at accounting convention. Accounting convention is used in solving conflicts arising out of the application of the accounting concept. So accounting convention therefore provides way out, or better still, in resolving all identifiable conflicts and puzzles emanating from the application of accounting concepts. Now we are going to look at the accounting conventions, because the accounting conventions provides a way out whenever one accounting concept conflicts with another accounting concept. Number one accounting convention we want to look at is the consistency convention. This convention states that accountants and financial practitioners are free to choose from alternative policies, and such a policy so taken must be strictly followed without deviations. This, by implication, portrays accountants as reliable, dependable, trustworthy, and forthright in their professions. The job of an accountant demands transparency as a basis of building trust. Consistency convention simply means that a particular accounting policy that is selected by an organization that is being used in recording of business transaction must be adhered strictly to, must be followed, so as not to conflict with other accounting concepts. Let me give an example. If an organization is used to using straight line method of depreciation to depreciate their assets, straight line method of depreciation should be consistently used by that organization, so it will not conflict with other accounting concepts. If an organization is into valuation of stock and the organization has been using LIFO, which is last in, first out, as a method of valuing stock, LIFO should be consistently used by that organization in valuing stock. That is accounting convention known as what? Consistency. The next accounting convention is prudency convention, and it states that accountants should not anticipate income, but all foreseeable losses must be provided for. And prudency concept can also be called conservatism concept, or prudency convention can also be called conservatism convention. And it states that accountants and bookkeepers should not anticipate future profits, but all losses should be what? Provided for. So, which means accountants should not anticipate income, but any losses must be provided for. So, in accounting, we don't record income not received, but we make provisions for future losses that may occur. What are these provisions that are made? Is because of prudency convention that we have provisions in the books of accounts. It's because of prudency convention. That is why we have reserves in the books of accounts. We make provisions for depreciation of fixed assets. Why? Because if we don't depreciate fixed assets, those fixed assets will run out and it will become loss to an asset in the future, to an organization in the future. So that is the reason why accountants need to make provision for foreseeable losses. We also make provision for bad debts that cannot be recovered. So when bad debts that are not recovered are provided for, when those debts turn bad, it will not become a loss to the business organization. The next accounting convention is materiality convention. The term materiality is relative, all right? That is to say, what is material to one person is immaterial to the other person. The essence of materiality is to assess the significance of an item in relation to the whole, and such item will be treated based on its size or monetary significance. What materiality convention is saying that an organization should capitalize an item it considers material, and an item that is considered immaterial should be written off as expenses to the profit or loss account. All right. Now let's look at an example. An item of revenue 4 million in an account of a company with a turnover of 15 million can be considered material and hence requires special attention, while the same 4 million in the account of a company with a turnover of 900 million may not be considered as material. This is an example of materiality. Another example that I can give is Tex Driller as a company. All right, we are growing to becoming big in the nearest future. If we purchase desk, if we purchase laptop, all right, we can capitalize it. It becomes our assets. While an organization like Shell Petroleum Company that is very big, it is classified as a multinational organization. If they purchase chairs, laptop, they will not capitalize it. It will not be seen as assets, but it will be seen as expenditure in their profit or loss account. This is an example of materiality convention. Let's look at the next convention, which is objectivity convention. This states that a financial record should be prepared in line with verifiable evidences, which means that whatever is considered as income or expenditure should be supported with documentary what evidences and facts. Objectivity convention states that all accounting records must have verifiable what evidences. That is the reason why we have source documents. Because when auditors come to audit records, they must have what they must substantiate with such a transaction. And this shows that the accountant is not biased with his or her record, because if the accountant record that a laptop is bought for 200,000, there must be a receipt to that effect, which shows objectivity that 200,000 spent on laptop actually went for laptop. So this is an example of objectivity convention. Now let's look at the reason why you and I need to study bookkeeping and accounting. Why is bookkeeping and accounting important to you? Why is it important to me? Number one is that it makes information available for future plans of a business organization. So when accounting records are properly kept, an organization will plan for the future, maybe to expand, maybe to buy more assets, maybe to employ more, or otherwise. Number two is that it makes information available for tax assessment by the government. So, bookkeeping and accounting makes information available for government to assess individuals and company to tax. Number three, it shows the assets and liabilities of a business organization. A business organization own assets and own liabilities. It will be shown in the records of the business organization. Number four, it shows the actual profit made by a business organization. The profit made by a business organization will be disclosed in the books of accounts of a business organization. It makes fraud difficult to perpetrate by employees because all accounting records are kept, all right, in the books of accounts. So it makes fraud difficult to be carried out by employees. The next is that it shows the total income and total expenditure of the business organization. All right, in the books of accounts, we see the total income generated and we have the total expenditure made. So that's one of the reasons why we study accounting. Then, accounting is an occupation, it is a career One can be employed as a bookkeeper. We have so many bookkeepers, like tellers in the bank, cashiers, stockkeepers. All right, they are all bookkeepers, account clerks. So that shows that accounting is an occupation. We have so many accountants on the field. That shows accounting is an occupation.